Hi, everyone. Nice to be back. It's been a while. So, in this session, I want to look at what we as individuals can get out of our trading. How can we access the market in the most efficient way? How can we set ourselves up to get the maximum reward and, to be honest, with the least stress out of our trading sessions? So, we do have, a challenge within our trading. We clearly want to maximize our potential, but there's one thing, a couple of things actually, I want to add and stress actually. Every individual has a unique personality and a set of circumstances that influences their trading. And just by example, it's our approach to risk. Everybody handles risk differently. Everybody has a different capacity to take risk and handle risk, and in particular when the markets start moving against us. So, very, very individual in that respect. We're all different in our ability to absorb information. Can we put that down to being an academic or not? No, I don't think so, because when things really interest us, if we really get into our trading, that information is available to us, and it's very, very important that we grasp it and are able to interpret it productively. So, we do absorb things at different speeds and our ability to take in more and more. So, maybe that will also change the way we trade, maybe the breadth of products that we trade, that kind of thing. Experience obviously is very, very key. If we're very experienced traders, then of course, we can trade differently. Maybe we can trade a bit more aggressively. Maybe we can look a bit more long term. It does change the way we do things. So, again, another thing that will contribute to the simple fact that we are all unique in the way we go about our trading. And probably the biggest one is the amount of capital that's available to trade. It clearly will influence the trades that we can put on, maybe the longevity of some of those trades, maybe our ability to take loss on board and cope with the market when it moves against us. So please understand that we're all different. There's no kind of copycat version in this, and don't try and compete with others around you, because they may have completely different set of circumstances behind them that means they will be trading differently. Basically, what works for one trader may not work for another. So, focus on your own game, as we would say. Focus on your assets and make sure you protect what potentially are some weaknesses to start, and build on those weaknesses and improve those weaknesses to improve your trading and maximize what you can get out of the markets. Now, outside of us as individuals, there's also not a clear-cut, strict set of rules that we should all follow to be successful in trading. Yeah, it'd be ridiculous for me to try and set down a list of rules that you must all follow, because circumstances are different and people will respond differently. And if we were all stuck with this strict set of rules, then things really would not go that well. And it would also take away, it will inhibit us a little bit. Sometimes we do need that little bit of flair in our trading, and that could be the thing that could differentiate a good trade from a poor trade. But the one thing I do feel is key, and it should be effectively the building blocks for everybody. And it's a great way of setting yourself up, providing a stable foundation for you. There's some key areas that we should look at, and I'm going to go through those fairly quickly over the next few slides. Now, we really are talking bigger picture here, but it's all about how we set ourselves up. And even if you have already been trading, it's worth focusing on some of these areas to make sure you're doing things right, to make sure you're getting the best out of yourself and your capabilities in all of these areas. So the first thing really is understanding what type of trader are you? Because if you do understand a lot more about yourself, you'll understand why you make decisions in the marketplace. I look here and I think about short-term gains or long-term growth. Are you the type of trader that really likes to nickel and dime the market, as I would say. You're in there every day. You're maybe doing, multiple trades, trying to scalp the market to secure a relatively small amount of money, but doing it consistently on a daily basis? Or is your mindset the sort that likes to look a little bit more at longer term trends, maybe looking at the strategic side of markets, really looking at the fundamentals, the macros, as we would say, and potentially that is, as we start looking at FX and we start looking at interest rate differentials as they move, there could be some longer term trends that we may want to look at. What interests you, what piques your interest on a daily basis, is going to help you maximize the benefits from markets when you put trades in them. And as you get more and more experience, there is a combination of both, where you could be nickel and dime in the daily markets, but still in the background have a nice long, forward-looking trend trade on there that you can leverage as the market continues to move in your favor. But the key here is to understand what type of trader you are, and once you've done that, set some goals. And set some goals that are relative to that style of trading. So don't try and set goals if you're nickel and dime in the market and say, I'm going to nickel and dime this market and I'm going to try and make 100,000 per month, when actually you have, and I'm just choosing these numbers, for example, you're only trading relatively small amounts, but on multiple times during the day trying to scalp markets, you're not going to achieve. So make those goals relative to the market and certainly achievable. So that's understanding who we are, and that may tell us what type of trading we will get involved in. The next one is really, really crucial. This really is the building blocks. It's finding a well-defined trading plan. What do I mean by that? Well, it's our process. It's how we go about things. We often hear about elite athletes, golfers. What is their process? They go to the practice ground. They do multiple exercises to really, really fine tune their putting, for example, if that's a weakness. So we actually should also, and they go about it rigorously and regularly. And that's exactly what we should do. We should devise a plan, the way we go about things. How do we create trades? How do we enter trades? How do we exit trades? What's the criteria behind all of that? How do we handle risk? What size of position, etc. We need to understand how we go about that. It's something that we need to actually repeat, and certainly repeat the things that go well and fine-tune the one that don't go well. But where you'll find this is really beneficial is when things don't go well, you actually revert back to this process, because it's a process that's worked in the past. And maybe you veered away from that process. So it's very important to have this building block behind you, this trading plan that you can always fall back on if things start going wrong, to try and help eradicate some of those areas that have maybe crept into your trading plan. Now, again, that sounds quite rigid, but the one thing we need to be able to do is adapt during that trading plan. Why is that? Well, purely because markets move, markets change, new information comes in, and we need to be able to adapt. Don't stick our head in the sand if new information has come in. Stick to our process. Where is my stop loss? Should I be getting out of this? Well, possibly, because new information is coming in. That's part of what we're doing all the time. We're reinforming ourselves as markets change and new information comes to us, but we are actually sticking to that trading plan and that process that we have adopted over the past. Now, within that, I did speak about risk management. Very, very crucial. How we handle our capital, how much money we put into each individual trade is very, very key. Not everybody, as I said at the outset, not everybody has the same risk appetite. Not everybody has the same ability to take on risk. So we need to be able to manage our trades in a way that's relative to our trading capital. And one of the key things about your trading capital is that you have to be able to absorb setbacks. What do I mean by that? That's simply trades that go wrong. If we're over trading, if we're over leveraged, maybe we blow the bank up right from the very start. I've always said trade in an orderly manner so that you earn the license to trade again tomorrow or in the next trading session. You cannot do that if all your capital runs out. So the use of stop losses, certainly some organized take profit areas and using your charts for those kind of levels, very, very important for us. So managing your risk, very, very crucial. And we should always be looking at how we go about that. A very, very big thing is our education, understanding of the markets. And this is a continuous thing. We should always be trying to educate ourselves, always reading up. This will help us create new trading ideas. It'll help us interpret information, whether it be economic data that comes through, all of these macro things that come into our world that help us create trades. These things change. Correlations change between products. We need to be continually educating ourselves to make sure we're on top of any changes and that we can respond accordingly. And, from the middle bullet point there as well, we also need to broaden our knowledge around trading strategies. There are multiple trading strategies out there. If we start becoming a bit one-dimensional in the way we trade, as markets change or as we move into new products, we may find they are not working. There may be different trading strategies that we can adopt that would work better in those circumstances. And we have to read up about those and educate ourselves on those. And a very, very key thing, as I mentioned, certainly when we're looking to utilize stop losses and take profit levels, is having a great understanding of all the technical indicators that there are out there. We may want to specialize in certain ones. Fibonacci's, we certainly got the candlesticks, and there's many others out there. Find what works for you, but keep educating yourself on them. Make yourself a better trader by reading. One of the big things that I look at, and certainly when you've been in trading rooms where you have teams of traders and many, many traders all in the same room, a lot of noise, a lot of emotions, a lot of shouting, sometimes crying. But emotions can cloud a trader's judgment, and it will lead to irrational decisions. And once you make one irrational decision, unfortunately, it tends to snowball and you continue to make more and more. And my best advice in those situations is just to square your risk up, shut up shop for that moment in time and go back and have a look at that trading process. How did you get yourself into that situation? And that's my solution also to point two, because clearly we want to stay calm and focused throughout our trading, because that's when we will perform at our best, and particularly during volatile market conditions, because that's when our emotions can get highlighted. And so the only way to go about this goes all the way back to that building block. You go back to your trading plan, your process, because this has been a proven formula for you in the past. Go back, square up, take a look at what's worked for you in the past. Maybe you veered away from that process, but when you go back into that market, or if you find your emotions starting to get elevated, think back about that process. Think how well it's performed for you in the past. Think that if I remain disciplined to that process, I believe in my trade idea, I have the right exit strategy, both in terms of taking a loss if the market moves against me or taking my profit, then I can stay in a much, much more controlled situation, excuse me, and avoid acting on impulse. And then finally, and very, very important, is how we evaluate what we do. This is a great opportunity for us. There's great data out there where we can start assessing ourselves and our performance from on a trade by trade basis, maybe just looking at our bottom line, maybe looking at all different things in terms of duration of trade. How does our trade change over time? But we should be able to analyze our performance and break it down into little pieces, match it against our trading process. And one of the good ways to do this is to write a journal. Why did I get into this trade? Why did I set that as my take profit? Why did I set that as my stop loss? if one of those gets hit, was it the right level? Could I have moved it? Don't make it a post-mortem, particularly if it goes wrong, but make sure we do evaluate. And if we look on the Plus500 platform, they have been providing traders with the Plus Me function. And this is something I would urge you to take a look at. I'm sure it's something they're going to continue to build on, but it's already got some great stuff there. And there will be some data here that we can monitor ourselves. If you go under the account heading of the platform menu, you click on the Plus Me tab, and I'm sure you'll see a wealth of data there that you can start looking at your trading, looking at how you're responding to markets and what you're doing, maybe relative to some other traders that are out there.